This changes everything. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a severe contraction in the U.S. manufacturing sector indicates major consequences for the economy at a time when we had a lights-out, blistering payroll report saying there was a ton of people hired in May. But is this another case of the BLS cooking the books, or is the manufacturing sector about to come raining down on this fire of a storm payroll report? Well, as we've talked about, the global manufacturing sector has been slowly receding, slowly contracting, and entering a recession. Many said this would not happen in America, and we're going to make the case why this report says that the things in the U.S. economy are about to get far worse. And we're hearing from some overseas friends that all of a sudden traders are going to be saying, ouch, in a big way over this weekend. Let's head over to Wall Street Journal, where we picked today's story up with a headline: U.S. labor market shows resilience with strong May hiring as employers added a blistering 339,000 jobs last month. But yet, for some unknown reason, at least in the headline, the unemployment rate rose to 3.7%, yet remains near historic lows. And the big attention on this report isn't just going to be the number, because we know that this is an indicator of a strong labor market. And there's some reasons why we saw May actually see some bigger than expected numbers. But where this is turning the focus is to the Fed, because mid-June the Fed meets again. We've heard them talk, some of them talk about raising rates, some of them about pausing, and the question is, with a strong payroll report, remember, we've heard Fed Chair Jerome Powell say this, that the labor market is too strong. He doesn't want as many people working. He wants to slow that down, putting perhaps rate hikes back in play, but maybe that's quite not the case. The jobs market added more positions in recent months than previously thought, as March and April's totals were both revised upward for a net gain of 93,000 jobs. But for some reason, the unemployment rate rose to 3.7%. But notably, business services, healthcare, construction, transportation, and warehousing were all among the sectors adding jobs. Low unemployment has put pressure on wages as employers compete for scarce workers. Wages grew at a solid 4.3% in May over the prior year. Now, you might want to wonder, why would we see all this hiring in May? Well, one of the reasons is we're heading into the summer months. We know the schools are starting to get out across the country, and you need labor, particularly in leisure and hospitality. Now, remember, we covered the ADP report the other day, and where was the bulk of hiring? It was in leisure and hospitality. Now, I happen to live in the vacation capital of the world, and what have we seen over the last couple months? We saw here a whole lot of hiring that turned into training, and now these employees are actually ready to go for the summer months. So the question, at least what I'm seeing locally here, is that the suggestion that perhaps there isn't going to be further demand for employees, and that the bulk of the hiring was going back to May. But something that doesn't quite add up here, other than the employment rate ticking higher, is why we're not seeing state claims go down. Here we can look at last week's initial claims. It's 232,000. Now, this is still historically a relatively low number. Remember, we got near that magic 250,000 number. I said, hey, if it starts to breach that in a material way, watch out above. Well, it pulled back, it slowed down a bit. Perhaps that May effect really mattered here. But look at this. If you look at continuing claims, they're still hovering around 1.8 million. So you'll notably, people that are perhaps in skilled labor or tech jobs, they're not able to go out and perhaps find work, whereas what we're seeing in the leisure and hospitality is a lot of unskilled jobs. And another factor that just kind of doesn't add up here is total claims really didn't move much either. They're sitting at around 1.6 million. So from what we would want to expect is we want to see these continuing claims drop, but we're not seeing that at all. And as far as any kind of relationship to the federal funds rate, many people believe that the Fed is in control of this. Well, here's the total non-farm payroll report against the federal funds rate. And if you look at these two lines, and it doesn't matter which one is which, the blue is non-farm if it matters, you'll notice there's virtually no relationship here at all. In fact, oftentimes you'll see the Fed cutting. You see the blue line rolling over and heading down long before the red line starts to slow. So there's really no indication here that higher interest rates would have any impact on the non-farm payroll, but we'll find out here in a little bit what does. The U.S. labor market sends mixed signals, giving the Fed reason to pause. Now, this is interesting because you look at that headline report and you say, okay, this puts the Fed back in play, even if inflation slows. What are they worried about? They're worried about a wage price cycle going on where higher wages lead to more consumption, which leads to higher prices. That's what they're afraid of right now. So you look at this payroll report and you have to put yourself in the shoes of Fed Chair Powell and of members of the FOMC board, and you kind of have to start leaning toward perhaps you need to raise rates in June. But as the Bloomberg kind of mentions, maybe there still is a case for a pause here. As markets reacted to the advance in payrolls, with Treasury yields jumping after the report, for the Fed, however, policymakers will be looking at the surge in the unemployment rate, not the non-farm payroll number, which was the biggest one-month increase since April 2020. There were 440,000 more people out of a job in May, also the largest monthly rise since the onset of the pandemic. So what we can kind of infer from this is they're seeing a lot of unskilled leisure and hospitality jobs being created, which we've noted from some of the surveys saying that employers really wanted to hire going into the summer months. But what have we been seeing from some of the large employers, the big tech companies, high paid jobs? These people are not coming back in the workforce, and it's unlikely you're going to see them serving beer or, delivering your food at a restaurant, because it's not a job that they're going to take. So the question is the unemployment rate, is a move higher in it enough to put the Fed on pause? Well, the answer is maybe. Here we can see the unemployment rate in blue against the federal funds rate, and now we have something that looks sort of like there's a relationship here. And what we can note is when the unemployment rate kind of flattens out, usually that's a sign that the Fed is pausing or cutting. Here we can see that kind of in late 1980s. We see it here and again in the early 2000s. The unemployment rate starts to flatten out, and notably the Fed goes into pause mode. You see it here again in 2007, and now you're starting to see it again. So if the Fed comes out next month, it says, look, we're looking at the unemployment rate more so than the non-farm payroll report, they do indeed have a case for pause. But yet that doesn't explain everything, because remember, for the non-farm payroll report, there's also another report called the household survey, and this time it completely disagreed with the headline number. And yet, this from Zero Hedge, while the establishment survey was a blowout beat in the strongest print since January, the household survey unexpectedly tumbled by the most since April of 2022, as it plunged by 310,000 jobs. So here you see, two different reports, and one saying, look at the surge in hiring in a place that we would expect it, again, leisure and hospitality. Here we have the household survey saying, not so quick there. We saw a ton of job losses. But one thing you should see a blowout beat in, well, that is your trading account. Remember, look at this. We keep seeing tech stocks go higher and higher. You're saying, how did I miss this? Look, we had a report. Our CTA-Timer report says, look, you should buy down here. And if you missed it, buy down here. And this thing keeps swooping higher. And look, here's a report back from January 9th. It said, look, we told you, look, the machines were massively short. We said this is the day they started short covering. This is where you should have started buying, taking positions and building into it. If you missed it, that pullback, well, the machine started buying back here again on March 15th. Both of these gave you the indicator you needed to start taking positions. Some of you are saying, we're going to put this report to the test. We want to see if it signals a reversal near the top. Well, hang tight. When it gets there, I'll show you, because a household survey in this case is saying that the non-farm payroll report got it all wrong. And here you can see that 310,000 plunge based on the establishment survey or the household survey versus the establishment survey. The question is does one drag the other down? Well, we can go back to late 2022 and we can see kind of the slowdown here. The blue line in the household survey eventually put a slowdown to the headline establishment survey. And one thing we should note here, that the headline survey is smoothed out to begin with. This is an outline report, at least in the bigger picture of things, suggesting that either there is a trend change and the labor market is going to get really strong going into the summer months, or, as I'm seeing around here, is just a bunch of hiring in the leisure and hospitality to prepare for the summer months. These people had to get jobs, had to get trained before we hit school out season, summer season. And as far as I can tell, the hiring around here has stopped. So it'd be interesting to see if in the future non-farm payroll reports, it stopped as well, because one thing that could put this all to an end, and we'll get to this here in a moment, is the manufacturing sector. But one possible for the massive divergence between the two reports is the birth-death model added 231,000 jobs in March. These are not actual jobs, but merely an assumption by the Bureau of Labor Statistics as to how many new businesses were created and hired workers based on statistical assumptions. So essentially, the birth-death model, if you're not familiar with it, is the BLS's attempt to establish people becoming self-employed. They have no way to actually determine who is becoming self-employed, and if they do, if they hire employees. So effectively, they make some numbers up every month, and that gives an indication that perhaps, and I think Zero Hedge said in March, I think they meant May in that report, but nevertheless, what we see is a BLS adding jobs perhaps at a time when they shouldn't be adding any at all. And turning to wages, the sequential print of 0.3% came in line with expectations. The year-over-year print was 4.3, just below 4.4. But is that enough? I mean, what do we really need to see here? Is we need to see wages outpacing inflation. I know many of you are shaking your head and saying, nah, Steve, that was a good number, but not good enough because my dollar's not going as far. Well, you're saying that. Well, you're right. Because here we can see the average hourly earnings of all employees, total private payrolls in blue on a year-over-year rate change against the consumer price index. And what do we know? That wages continue to fall behind consumer prices. And what does that mean? For demand in the economy, it means, of course, less spending, less discretionary spending. And then you start looking at these summer months where a lot of business are really critical. They need a big summer months to get through the lean winter months. And you start to wonder if this is why we're not seeing a whole lot of demand here, at least locally. I've noticed numbers seem down a little bit over last year. I'll be curious to see in the weeks that come if that changes. But what about where you're at? Are you seeing demand fall as we head into summer? Are you in a summertime business? Where things are at? Because one thing I do know around here, at least last weekend during the holiday weekend, the restaurant business was pretty packed. Curious to see how that changes, but love to know, what are you seeing in your area? Because one thing that doesn't add up in this report either is the participation rate. Now, the labor force participation rate is a percentage of eligible people, the eligible people in the workforce that can work. And notably, we see no change here. So if the non-farm payroll report is indeed correct, what this establishes is that people who are looking for jobs found jobs, but no new people entered the potential workforce. And the problem now is becoming, as we started the show out, is there's major consequences with what we're seeing in the U.S. manufacturing sector. It's entering what is a severe contraction. This from Reuters as U.S. manufacturing slumps further in May. Not just slumping, we're talking about a severe contraction. But notably, look at this. The headline says employment picks up. So the math doesn't start to add up here at all. Now, if you believe the economy is entering a no landing, a soft landing, and about to rebound, what you want to do is hold on to your skilled workers because you don't want to do this mistake again. You got rid of a bunch of them during the pandemic. You've now retrained all these people. You've got a little bit of money that you can keep around a while, so you're going to hold on to them. And that's what we're seeing is a big bet by manufacturers that things are going to turn around. But when we look at the numbers, it doesn't make a lot of sense that it is. Here we can see from yesterday's ISM manufacturing PMI, here is that severe contraction now at 46.9, 45, when it gets under 45, I mean, this is massive recession zone. So we're right there. We're seeing this happen now. But look at what they're headlining here. New orders and backlogs contracting. That doesn't sound really good. Production and employment growing. So that doesn't make a whole lot of sense when the first two are contracting. Supplier deliveries are getting faster, meaning they're getting their product quicker. Raw materials orders are contracting. Customer inventories too high. If the inventories are too high, guess what you don't need? New orders. Prices are decreasing. Imports are contracting. So you start to look at the headline number and you say, yeah, Steve, that makes a whole lot of sense. What doesn't make sense, and let's dig a little deeper in this report, is why employment is holding up. And I think it's only a matter of months before we see that start to turn. We'll make that case here in a moment. Here we can see, digging into the report, look at new orders. Now remember, under 50 is a contraction. The smaller the number, the bigger contraction. We went from 45 to 42. So new orders, severe contraction, recessionary numbers. Production held steady. So the factories are still producing here. They're still maintaining their employment. That came in at 51. Supplier deliveries are down at 43. That's severe contraction. That means when you order something as a factory, you can get it pretty quick now. And even inventories at the factory are holding steady. Customers' inventories are getting too high, which suggests demand is declining, which makes perfect sense knowing that wages aren't keeping up with inflation. Prices are falling. We've made that case due to oil prices. But look at this backlog of orders at 37.5. What this is telling you is factories are rapidly working through their massive backlogs. And at some point, they're going to run out of work for their workers to do. And that's the problem the economy faces, because once they do and they start hitting the unemployment line, well, there's no stopping this, because if you think about it, what would you rather have? Someone in a manufacturing job or somebody waiting tables? Now, granted, both are useful jobs. We need both of them for different reasons, but one pays a whole heck of a lot more and has a lot of stability with it, or one doesn't. And that's the key here. But look at the responses. This is notable. Let's just look at a few of these. Overall impact from our business is mixed. Now look, these don't line up with what the numbers say. Demand continues to gain momentum. Business is returning to pre-pandemic levels. That, my friends, not necessarily a good thing. Although sales are slightly lower, they're holding. Demand remains strong. So we're not seeing this match up in the headline numbers. But look at this. When we take a look at new orders here, and this is critical because when new orders go down, this being from the Philly Fed, you look at the 4-week moving average of initial claims, and what do we know? That as new orders go down, what do you need? Fewer people to actually produce things, so you eventually lay them off. Right now, what we're effectively seeing is a major pause by manufacturers, hoping the economy turns around. And that's why I'm trying to suggest to you that this non-farm payroll report is meaningless. The fact that it had this big number, the fact that it was a lot of leisure and hospitality is irrelevant, because we're potentially 1 to 2 months away, if the economy doesn't turn around, from U.S. manufacturers putting their hands up and say, yeah, you know what? It didn't work out for us. We got to start letting some of you go. Here you can see when we look at the Philly Fed against the total non-farm payroll report, it hits it with a major lag. You can see a huge downturn in new orders long before you see the non-farm payroll report on a year over year even go down. So suggesting to us what we kind of know is the non-farm payroll report is a largely useless report. Not the most useless one that the BLS puts out, but pretty close to the top. How about the unemployment rate? Well, it gives us a little bit better signal. Here we can see looking at new orders. As new orders peak, you tend to get a kind of a trough in unemployment. That seems to be somewhat consistent of what we're seeing in the reports here, suggesting that indeed the unemployment rate might be a more accurate signal, at least if you're a central banker. But how about when we throw in the 4-week moving average of initial claims against that new orders? Well, here again, we're looking at this saying, yes, there seems to be something. When we have a definable peak in, or this is current employment, I'm sorry, not new orders, current employment. We already looked at new orders, current employment. When we see a marked peak and followed by a slowdown, that does indicate kind of a trough in the 4-week moving average of initial claims, suggesting that it's only now a matter of time before employers just start laying people off. My guess is they're going to go another month or maybe 2. I'd love to know what you think. You know, what is a pulse where you're working at? You know, what is the sentiment? Are you hearing things from management coming down that if things don't turn around, there's going to be some layoffs, or is everybody pretty solid? Because now coming out of the Middle East, they're making threats again, but this one I don't think matters that much. As OPEC Plus prepares for a weekend meeting after Saudi warned speculators to watch out. Ministers face an oil market riled by supply volatility, demand uncertainty, and a prospective recession. Look, you want to know what's going to make a global recession even worse? If you said higher energy prices, you nailed it. And what we're seeing is a broad slowdown here after last week's big crude draw. Many people thought we'd see it again. We saw 4.5 million barrel build last week. We're seeing Cushing. This feeds into gasoline prices up 1.6 million barrels. We note that gasoline inventory is down only ever so slightly. Distilled stocks, which you should see drawing down going into the summer months as people get on planes and travel, that should be headed lower. But what we're seeing is continued signs of a broad-based slowdown. Once the manufacturing sector starts to lay off, my friends, it's game over. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.